if you ain't first, you're last. And you better understand that. That's why we just happen to be first all the time.
Welcome back to the channel, everybody. Today, I am once again joined by my very, very good friend and colleague, Mr. Clayton Astore. In today's video, we're going to be touching on Clayton and I's risk management principles that we are implementing in our trading day in and day out in different markets. So, Clayton, why don't you get us started a little bit and fill us in? You know, we obviously know you are, I'm not going to use your nickname from the Discord, but you are very familiar with options trading and particularly spreads trading. So why don't you tell us a little bit about how you're allocating your capital to your different spreads, namely? We'll start off with spreads.
So for my spread specifically, my spreads are extremely conservative. So I'm very, very confident in allocating more capital to them than I otherwise would be in regards to other forms of options trading. For my credit spread specifically and my options overall, I only utilize options trading strategies, i.e. there are two, credit spreads and leaps. I utilize them only on ETFs. That's it. I do not trade options anymore. You and I had a full conversation about that. I do not trade options anymore on individual securities, no matter how good the opportunity, no matter what I think is available, because I just do not have the parameters that I have with ETFs nor individual securities in my data anywhere near as consistent in regards to their volatility, their year-over-year growth. There's a lot of individual securities that will outperform my ETFs. That's not what I'm looking for. I can get what I need out of my leverage and my options without, an ETF doing 100% in 2 months. And that's what I look for. I look for stability, I look for consistency, and I look for risk to reward. And risk to reward with my ETFs, especially if I'm waiting for a certain percentage or multiple percentages down in my individual ETFs, there's a lot less risk in my eyes. So that's how I manage. And my allocations, it's all I'm one of the only people that I know that is a calculations-based trader, because I just haven't spoken to a whole lot of people. I'm sure there are people and institutions that utilize calculation-based trading, meaning I don't trade really off of technicals. I trade off of percentage down on various ETFs. And I'm covered all the way down to a 50% and some change pullback for anything that I do with any of my ETFs, both in equity purchases, shares, credit spreads, and leaps. I want everything that I do to just provide me accelerated growth, but act as much like equity as possible. And that's why I trade the way that I trade. So we can get into all of that. But I would like to ask you a couple questions on your allocation, because now that you're moving into the stock market, moving a little bit away from Forex, you're still taking a lot of these same principles, and they're already working out for you well. So if you don't mind giving me a little bit of a rundown on your day trading, scalping, short-term swing trading principles, because I have quite a bit of day trading background, and I have a very simplistic formula for how I day trade, and I want to see if they correlate.
Yeah. So that's a great question. And the way that I approach my risk management is more in a trader sense than I think you do. And when I say that, I mean, I'm looking at very specific levels of risk. So for example, I'm looking at per trade risk, how much of total percentage of my account is going to be allocated towards any one trade. Right. And then outside of that, I'm looking at per sector risk along other things. Right. So it's interesting because where I am right now, I obviously know that managing a larger portfolio, managing different portfolios has different risk types for me. So a larger portfolio for me, I'm going to be risking very, very low amounts of my total percentage, maybe even 1% to 2%, maybe even less, depending on the type of setup I'm seeing. But that being said, remember, these are quick trades for the most part.
Right.
But in my shorter, my smaller accounts that I'm okay accepting a little bit more risk, I'm upping that percentage to sometimes 5 to 10%, depending on the expiration, depending on the setup as well. So for example, our meta position, where we have long-term meta positions. So for example, in that position, I'm risking around 10% of my capital. That being said, I also understand that I'm not going to let that option expire worthless. So I'm not going to lose 10% of my account, even if that trade goes down the shitter. The most I would probably lose on that is I'm going to cut it if it goes anything more than 3 to 4%, right? But in my Forex trading, for example, I may be in and out of the market very, very quickly. So on that account, I'm risking, like I said, 2% a trade and trying to approach the market in that way. Does that answer your question a little bit as to how I'm gauging my risk depending on account size, per sector, per trade, things like that?
No, it absolutely does. And right with what you've described, you and I are completely different, even in the short term. Completely different, which is incredible because you and I both do well, which is fantastic. You and I are both profitable traders and profitable investors, long term and short term, in multiple different markets. You've got Forex, crypto, and the stock market. I'm just getting into crypto, and I'm primarily in the stock market. For me, my allocations are different. Down the road, chances are I will have a larger day trading specific portfolio, purely for entertainment. But the way I will approach it is not based on entertainment whatsoever. It's based on discipline and consistency on what I want to see return. For my larger portfolios, I am always very cash heavy. When the stock market is at all-time highs and pushing all-time highs and breaking into them, I could be as much as 60% cash even on my long-term portfolios, which to most people who both have financial advisors, let hedge funds trade for them, or they're just trading on their own, or they're looking at their retirement accounts, usually they have no cash, if not 10%, even with advisors in the whole nine. For me, I make almost all of my money from larger moves in the market down. So every time the news starts popping out a new variant and we get a 5% drop in response to the variant, I'm deploying cash there because I'm very cash heavy. And I'm confident that that's relatively temporary. Even with the initial 36-ish% pullback that we had with COVID, that was temporary, very much temporary. And if you're looking long-term enough, it was temporary is the only way you can describe it. And the best part about it was, even if you weren't looking that long-term, I believe the COVID dip was fully recovered in 3 months, thereabout. Yeah. Fully recovered, 36 and some change, I believe, from the high pullback. And
nobody thought it was going to happen. Everybody was questioning the V-shaped recovery, and it happened.
Well, that's because it was a major event. I'm not underplaying COVID by any means, and I'm not underplaying what it's done to millions of people across the globe. What I am underplaying, though, is the overall investors' confidence, because for a very short period of time, everybody and their mother thought the world was ending. And then about a month later, everybody realized that we've had a long list of COVID-like diseases, viruses, and they just started going, okay, this is just something that we're going to have to live with, and we're going to have to create preventative measures to make sure that we are safe. I believe the best preventative measure is just to make sure that your mind, body, and health and everything is safe and healthy, bottom line, so that you don't necessarily have to rely on anything else. But in some cases, maybe getting a little bit of help is not a bad thing. But for me, with my day trading and how I would manage a day trading portfolio, knowing that I really don't do anything day by day, other than look for positions to enter when the market's falling based on my calculations, the way I would handle it is with a portfolio, a larger portfolio. Let's say we're utilizing a $1 million portfolio for day trading and scalping, mostly day trading, not necessarily scalping. I would be using probably 20 to 30% of the portfolio, so about $200,000 or $300,000 per trade. And I would keep my stop losses so tight that I either am immediately cleared out of the trade, or I am confident that that was where I needed to be for that position, and it's going to go in my direction almost immediately upon entry. So obviously, it takes a lot of experience in order to make sure your P&L there is high and almost even. Because if I'm looking for 20 to 30% return on the upside and I get it, and I have a 5% stop loss and I only lose 2 or 3 times before I hit that one, my net percent return on my capital is 10 to 15%, right? Depending upon how many runners I leave, depending upon how far out my expiration is. And even with day trading, and I do this still every now and then, rarely, but I still do this, I will get in a day trade and I will allocate additional capital to the trade so that I can be far more conservative than I would be otherwise. So, and it's a larger port strategy, But if you are going in the money, so your delta is higher, so the minute you get the buy volume coming in, you will start netting far more on the dollar because of the higher delta. And I will still go 2 months out on my calls, 3 months out on my calls, in case, God forbid, I have to swing it, or I cut my main position, make my profit, and want to swing my runners.
Right.
And if I swing my runners, I could get 60 to 70% on those runners, depending upon how big of a floor that I caught and the buy volume that was available and what the price action was. Those runners could net potentially more than what my overall position netted, because I'm getting out very conservatively at a 20 to 30% on my primary position for my day trades. So that's a little different than what you just described, because I am going with a much larger percentage of the portfolio.
Yeah.
That's because of how conservative I am on the downside. So my risk to reward is super tight net.
Right.
I either lose 5% or I'm netting 30+% thereabout.
Yeah, that is a different way of approaching it, but by no means is it incorrect. It's very, very intelligent. And I completely see why. Yeah, no, especially in the options market, it makes a lot of sense as to why you're doing that. So I'm curious. I have a lot of questions.
Okay.
First, when you're legging into spreads,
Yes, sir.
how much is your percentage allocation per leg, and how many usual legs are you taking per full trade?
Well, I can go over kind of how I map that out, but I can't necessarily go over the specific calculations that are behind how I allocate everything. I developed
So it's different every time.
Well, every single leg is unique. Every
Okay.
single leg is very unique. They are not the copy and paste same leg per percent down. Every leg has a certain parameter based on what my entry price is, meaning the share price. And the share price is correlated with my calculations to how far, specifically my largest ETF that I trade, SPY, or my heaviest allocated ETF that I trade, depends on how far it falls. There are certain levels that I've realized just by back testing that SPY has a larger propensity to fall down to and bounce. There are certain levels that SPY will get down to and bounce that have a lower percentage probability of happening. But here, that's a bounce point when that's happened in the past. So I have certain allocations for what I've gone back and back tested and seen that, hey, SPY gets down to X, Y, and Z percent. I have no problem inserting a little bit more capital here as long as I'm still very conservative. My credit spreads, I usually stay 6 to 8 months out, primarily 8 months. And then for my leaps, as of right now, what I've added into my calculations are about 1/3 of what I believe that SPY will be able to do in a year and a half. And that's the dollar amount that I go out of the money for my leaps. And those leaps are far more conservative in regards to how much and when I allocate than my credit spreads. And what's less conservative on that side rather than more is my equity. I am far more with the larger portfolios. I am far more interested in pulling the gun and pulling the trigger at almost any percent down, but they're even, relatively speaking, unless there's a back test that shows me, hey, SPY hits this point and it bounces historically. Then I will be allocating a decent bit more with equity. But like you mentioned, with smaller accounts, my smaller accounts have no equity purchases at all. And then some of the other accounts are only leaps because the credit spreads, I just can't allocate the capital that I want to allocate. So I've got accounts that are just leaps. I've got accounts that are a mix of both. And then I've got larger accounts that are primarily equity based. And that is equity in ETFs as well as individual securities, but only leaps and credit spreads in ETFs.
Got it. So could you give us a little bit of the secret sauce as to the percentage allocation, whether I don't want you to give away any proprietary numbers, but whether that pertains to like an average percentage of your account per leg or the total amount of your account that's at risk once you have legged in all of your positions?
Yeah, I absolutely can. I can give you a broad range. So one of the things that I did was I went back in time and I looked at all of the most traumatic events in the stock market in regards to percent down, percent sideways over a period of time. And I found that in order to protect myself at all points in time, I still need to have a certain allocation available to me of cash. So my allocations cover me all the way down to and this is because this is more proprietary than anything, and I want to make sure that I am here from today all the way until I'm 60. I want to make sure I'm around and there's no market event that can knock me out of the market. That's why I do what I do. That's why I'm as conservative as I am.
That's the most important, surviving.
Right. Sustainability. So that being said, to follow that up, I need to make sure that the most traumatic events are taken into account, and that's where I'm the highest leveraged. So if we look at all the major events in the stock market, every single major event, including the worst couple, have eventually recovered. And if you look at, the stock market, for example, halving itself, being down 50%, even when it was down 50%, there was room up, sideways, and then room up, and then maybe sideways and down. But that being said, the way that I've developed my model is that between 30 and 50%, those are my largest allocations of cash. And that is to be as preventative and conservative and safe as possible. But that also being said, I will make more money than any other percent down or calculation that I have between 30 and 50%, because that's the heaviest allocation I have. And that's the farthest the market falls.
Right.
So if it falls that far, the beginning half, the former, will be hit pretty hard, depending upon how far we stay down. But that being said, I will net far more in the 30 to 50 range upon retracement than I will even close to what I'm netting in the beginning entry to 30%.
Yeah.
So that's how I balance that out. The other part there is after a full deployment, after SPY has halved itself, I am still 30% cash. I am still 30% cash.
Always.
On what?
I think that's good.
And the way that I do that, the way that I guarantee that, is whatever cash I have on hand when the market starts to fall, I plug it in to my algorithm and it spits out per all the numbers that I need exactly what I'm using per leg, per trading strategy. And then on the bottom side of that, it says you have this much cash available at the end of that, which is 30% always of what's available.
Understood.
So even if the market decides to completely wipe me out for 2 years, I'm still 20% cash. So inevitably, I will have a time to enter in that cash, and I will be able to regrow and retrace. And as the market retraces, my 30 to 50% legs, that allocation, will be netting more and more and more and more, because they're still year and a half out. They're even there from that fall, which, a 50% fall could take a long period of time, or it could happen within a week, pending market halts. So that being said, I'm still waiting, long periods of time to leg into those positions. And even if it takes, a year or more for the market to retrace back up to previous highs, once it's retraced up to previous highs, that's 100% return from bottom to top on just equity, just SPY, since it halved itself.
Right.
So that means my options and my leaps, they're up hundreds of, even potentially thousands % on the leaps, and I'm getting real close to maxing out my credit spreads, way ahead of schedule. And
you're just waiting for the day that we get a 50% retracement.
Oh, dude, I'm waiting for the day, because the best part about it is the further out my strike prices are for my credit spreads, the lower my risk is and the higher my potential profit is. So those are way away. So I'll buy them, and I'll buy those strike. For example, SPY is at $500. It halves itself to $250. Okay, I will go and get a credit spread, a bull put credit spread that surrounds previous all-time highs for a year out, and my P&L, we could look at it, it would be nuts. The amount of profit that I could make to loss ratio, nuts. Phenomenal. Beautiful. And that means at 50%, with my credit spreads being one of the safest vehicles for options trading, That means for every $1,000 I risk, I'm good. It's probably a 6 or 8 or 12 to 1 at a 50% dip. And now that I think about that, I'm going to go back and make sure that I'm cleared for all that, because I've double checked it and I've backed it up, and I want to make sure I'm right on the numbers. But the P&L ratio, the $1,000 loss that I could put in to X amount that I could gain being that far out.
Risk to reward.
Risk to reward is beautiful. And that also has to do with risk management, which is our topic at hand, which is why we're going over all this.
Yeah, of course. Awesome. Well, that was all very, very insightful. So I'm curious now, what is your approach to hedging on the downside when we are, we're going from that 5% pullback and we're all the way down to 30? What are you doing in between that time frame?
There's two things. Here's a small port option, smaller port option, and a larger port option, but both of them can be utilized in both capacities. So that's a phenomenal question, by the way. You will not catch me anymore. And I used to dabble with it and I used to experiment, but no longer will you ever catch me buying. And it's so funny. I'm reflecting in my head about our last video about my trading strategy and how I utilize credit spreads. And even since then, I've grown and developed so much that the principle overall has remained the same, but the minute details have very drastically changed for the better. So to answer your question, which is why I'm so excited about having these conversations, and we're going to keep having them periodically so that people can reflect on what it is that we're growing with and what we're reflecting on to get better as individuals. To answer your question, there's two things that I would consider doing. You can buy equity in something like UVXY or the VIX, right? You could buy that kind of equity when SPY is at its absolute highest. And then you can buy a little bit more even after it's overextended past what you felt like was the top, right? I'm always legging in. You're never going to catch me going, all right, I could buy 1,000 shares of X, Y, and Z. That's right there where I'm going to buy it. Hell no. That's dumb. It's just no deal, especially for somebody who's doing long-term. And people say, it doesn't matter where you buy stuff long-term, right? As long as you just get the money in and you just let it do what it needs to do. No, absolutely not. All right. Averaging down and average cost is more important than you just going, as long as I invest long-term, I'm good. Well, you are, relatively speaking, but you're not going to maximize your return.
Of course.
Plain and simple. So another thing that I do to cover all of my equity positions, and I like to, specifically for me, I buy 100 share increments unless I'm legging in and I just don't have the cash to do it. I like to stick in 100 share increments so that I can utilize this trading strategy specifically, because I do not buy puts. I don't buy bear call credit spreads anymore. I don't buy bear put debit spreads anymore. I just don't. What I do instead is something that I cannot lose with. Cannot lose no matter what the stock does. If it goes up or if it goes down, I can't lose. And it's deploying covered calls to protect your downside. A very intricate strategy that a lot of people do not understand. A lot of people realize that covered calls are a way to net additional premium so that you can then reinvest into your share position, just like a dividend, but on steroids. But that being said, if you have a volatile stock or a stock that you feel could fall at any time with the market or with news or what have you, if you come in and you wait for the stock X, Y, and Z to be at all-time highs, let's say you have 100 shares of it, and you cover that stock, let's say you bought it at a dip. You bought stock X, Y, and Z at $100 a share, and you've held it for a year. Now it's at 150, and it's breaking all-time highs into that 150 range. You can sell a covered call for how far out that you think it's going to grow. Be very conservative. So if it did $50 in a year, I would say cover the stock, just make it very conservative. You could cover the stock, or this is what I would do. I would say, okay, the stock is capable of doing $50 in a year. That means if I'm going to sell a call that's 6 months out, I'm going to do $50 a share, because that's half of that year. So, chances are if it does it again, it's going to do $25 every 6 months. 50 the full year. So I would cover it 6 months out for $50 a share out of the money. And some stocks don't have a lot of premium doing this. So you have to find out what works best for you in regards to this strategy. That being said, I can cover that call, or I can cover those share positions way out of the money. And then at all-time highs, if stock X, Y, and Z from 150, and I've covered it, let's say I 6 months out, I sold a $200 call. I would net a certain amount of premium. And then let's say at all-time highs, stock X, Y, and Z at 150 falls $25 a share. So it's lost 50% of its growth. That right there will remove about 50% of the value of your covered call that you sold, that didn't cost you a dime, that you sold for 6 months out, that you netted premium on, and now it's 50% less. So you can lock in those profits, close the trade, and you get to keep that premium because the share price went against you in your favor for the covered call. If it went up, then hey, you covered it for $50 out of the money, and if it sells, you net so much on the shares that your equity return is just unbelievable, right?
Right.
Because you bought a major dip, you sold a covered call that was way away, a strike price that was far away from your average cost. If it covers it and it sells, great. You're a winner. You're an absolute bull. You're a winner. That's phenomenal. That being said, that doesn't happen all the time, especially as conservative as I am with my covered calls and the strike prices I choose. So stock falls, you close the covered call, you wait till it returns back to all-time highs, and you wash, rinse, and repeat. And that's how I protect my 100 share increments of equity. That right there. That is the only way that I protect them. And I'm completely fine with that because it nets me premium and I get to cut my positions. And as the market's falling, for example, this past week when SPY was falling the 5%, I had covered almost everything I had at all-time highs. And I was netting a lot of premium, and I covered it all the way out to June, which is about 8 months from now, 7-8 months from now. And every single covered call with that 5% pullback, almost every single covered call was in excess of 40+% return. So I closed them all. And now we're recovering. And once these stocks get back to their previous all-time highs, I will have limit sells that I already put in for the expected share price. They will fill, and then I'll do it again. That's how I make money without buying bearish positions. That's how I make money. Well, I mean, I guess you could call this a bearish position, but that's how I make money when the market falls. And I'm also legging in as the market falls. So as it runs back up, at the top, I'm selling all my covered calls and netting more premium, which is more cash for the next dip. And
your long-term positions are already in profit.
Correct. And I'm exiting all my long-term positions once the market's recovered. And it's just 3 or 4 different income sources within one portfolio. And then it all goes back reinvested into the portfolio. And then next SPY dip, it's bigger and bigger and bigger. And I have more cash. And the best part about it is I don't care how much cash I have because I stick the cash available in my algorithm that I made, and it spits out everything that I need to deploy.
Right.
And then I just sit back and click my mouse a couple times, text you a little bit. That's it.
It's very automated.
That's how I like it, dude. I like sitting in my chair and watching what I want to have happen.
Yeah. Yeah, absolutely. So we're coming up just on 30 minutes now.
Oh, I'm sorry about that.
No, I'm glad you did, bro. That was a lot of very, very good information. So is there anything, not to have this go too long, is there anything that you also feel like you find valuable in your risk management strategy that you would like to share?
There are two things. And it depends on whether or not you've been disciplined enough to build your capital, or you're just starting out and you do not have the capital required to be as conservative as one would like to be. Something that most will realize is that the more money that you have in your accounts, the more conservative you should want to be, because it takes less of a percent return to make a larger amount of money. 1% of $1 million is far different than 1% of an $1,000 account. Far different. So, funny enough, Dakota's calling me. It's far different. So that being said, for people who are trying to grow your accounts, find the most conservative method that you can to grow as quickly as possible. For your larger account, folks, find the most conservative way to net a mid-range growth. And a mid-range growth I'm referring to is between let's say an average return of the S&P 500, which usually everybody says it's about 10 to 12% at best. Right now it's doing about 20+%. If you can beat out the S&P 500 utilizing conservative growth strategies year over year, and you've got a big portfolio,
You win.
you win.
People would be throwing money at you if you could consistently outperform the S&P 500. Especially not taking on too much risk, people would throw money at you.
Hit up my line, Chief.
Awesome. Is there any other questions you have for me on the back end of this video?
Yeah, well, I didn't get to ask you a whole lot, so hopefully next video will be something that's more centered around what I know about you, so I can ask you more questions regarding this. But for you specifically, since you trade completely different than I do, I would love to hear your just any kind of advice that you can provide to somebody who is trading on a shorter term, regardless of portfolio size. If they're trading on a shorter term, if they're leveraging shorter term options expirations, for example, or if they're trying to really do well on maybe a candle move on the 5-minute. What would you have to say to them? Because that's something that I can help with, but not like you can.
That's a very good question. So I think the main discrepancy between your trading style and my trading style is yours is obviously longer term, but also my trading style, I think, is a little bit more reactionary to what the market is giving me. So for example, you just have set numbers where you like to add. For me, I wouldn't do that because my brain is tailored to, I need to know why I'm doing this. And of course, yours is because you have the 5% pullback, but in mine, I need to connect the dots technically. When I started trading, I started with technical analysis. It's always how I've looked at the markets. So in that sense, I don't need to deploy all the same strategies because if I see the market going down, I can cut my long trade and go short, right? I can just buy puts. But for people that have smaller accounts and you're trading, first of all, the main thing I would say is find out how you're trading, right? Understand what you're trying to do. If you're more reactionary like me, you're relying a little bit more on technical analysis and actionable trade setups. Or if you want to just be more like Clayton style, more passive, longer term, but obviously still centered around the numbers. Determine where you kind of fit into. There's obviously other kinds of traders. I'm just using these two as arbitrary examples. Find out where you exist in. And to answer your second question, my main recommendation would be to use technical analysis, because in my opinion, technical analysis allows me to get out of losing positions faster than anybody else would be able to in a normal account. It allows me to capture really high risk to reward situations, which is what I find is the main differentiating factor, which allows me to maintain proper risk management because I can keep my losses small, but also have really high risk to rewards. And those would be my main two tips. Just understanding where you are in markets and reacting to them has always worked out really well for me and has enabled me to implement a consistent but robust risk management strategy, which I've been able to implement for a pretty long time now and not have any severe drawdowns by any means.
Well, I mean, in regards to anything that I would expect, you always exceed expectations when I ask you questions. So I appreciate that.
Thank you very much. I appreciate that, especially coming from you after this 30-minute gold mine you just gave us. But yes, we will absolutely do another call very, very shortly. Thank you again so much for your time, Clayton. Always glad to have you in the videos. You are a treasure chest of wisdom.
I appreciate that very much because for the longest time, I did not have any confidence in my ability to obtain and deploy and apply information that I was just trying to soak up like a sponge. And one of the biggest things is the more that I spoke to people about what I was learning, the more I could articulate what I was learning. And the more I reflect on what it is that was coming out of my mouth and the conversations I was having, the more I realized that there are certain things that I say that there's holes, right? And those holes I always want to look to fill. Those gaps that are created just by either lack of knowledge or me just not being entirely sure about something, I can reflect back and say, hey, you had no idea what you were talking about, because that's a brand new principle that you're trying to understand and deploy and use for yourself, right? But the individual you were speaking to knew about it. which is why you learn from that conversation. And that's how I apply my trading. I cannot learn from my trading without going into my transactions every single day and seeing what I did, why I did it, how it applied to my overall strategy, or did it go outside of it, and why did I do it overall, and what larger part did it play into my portfolio. And then I sit down and go, all right, let's gather all that up. What is the most important thing regarding that I need to change right now? What did I mess up on bad enough that needs to be changed right now? And sometimes the market's really good to you. For example, in September, I traded a whole bunch of individual securities and lost a whole bunch of money on credit spreads and individual securities. But the market rocketed up so much, and so much of what I bought did so well that I was still net positive on the individual securities, barely, but still net positive. But then I turned around and looked at the ETFs, and I didn't lose a single trade. I was 100% on ETFs. And I was thinking to myself, all right, well, hard stop here. These guys are done. They're gone. I can buy shares and sell them anytime they're high because I'm only getting mega caps. But on the credit spread side of things, I went 100% because the market provided me the opportunity to do so, and it did well. But that being said, I needed to make sure that, okay, just because I'm buying this dip doesn't mean it's going to go up now or in the next 8 months. So now I have to back test it. Now I have to provide calculations. It's all reflection. That's the most important thing that I can leave about risk management is implement a strategy that you think is comprehensive, double check, triple check that it's comprehensive, and then turn around, deploy it, and realize that it's not yet. Because I will always be learning, and I will realize there's going to be holes in my work until the day I stop trading.
Well, you are very, very quickly working to get rid of those holes. The reason I was just smiling the last couple of minutes is because you and I could honestly talk about this subject for hours on end. And just listening to you talk actually just made me think of another really important thing that we have to touch on, which is leaning into your edge, right? And introspection is the way that you and I go about that. But you make a really valid point in what you just said, because you were able to, and this definitely applies to risk management, how you saw you didn't perform well in this one sector. And in this case, you're talking about individual securities, but you perform really, really well in ETFs. So by you leaning into your edge, you are providing a more solid risk management plan because you are actually getting better returns, much better returns in this area rather than this area. So that's just one thing that I pulled from what you just said.
You go from being able to handle the chop to making the chop yours. And that's what I'm going to leave this on. And what I meant to say was you go from not handling the chop to handling the chop. But I messed that up. So that's on me. But guess what? You and I create the chop these days. All right?
Absolutely. Absolutely. Clayton, again, thank you so much. I'm sure we'll have another one of these shortly.
Absolutely. I'm looking forward to it. Thank you
Awesome.
so much.
Talk to you in that one.